Hi friends, welcome to my channel InfoCraze. Today we will discuss some important questions that may be asked in a job interview for the position of mid-level accountants. The interview questions may revolve around assessing your knowledge of basic accounting concepts. If you find the content useful, please like the video and subscribe to my channel for having easy access to my future videos in the field of finance and accounts. Now let's get started. Question 1. What do you understand by going concern concept in accounting? Going concern concept is a fundamental principle in accounting which assumes that a business will continue to operate indefinitely or at least for the foreseeable future without the intention or necessity of liquidation. This assumption underlies the preparation of financial statements, expecting the business to continue its operations and meet its obligations. If the auditors have significant doubts about a company's ability to continue as a going concern, they may report the same in the financial statements, ensuring that the stakeholders are aware of the potential risk regarding the company's ability to continue its operations. Question 2. What is matching principle in accounting? Explain its significance. The matching principle is a fundamental accounting concept which prescribes that expenses should be recorded in the same period against the revenues they help generate to display the true benefit for that time. Thus, the matching principle ensures that income and related expenses are recognized together, which leads to more accurate financial statements. Applying the matching principle allows for better comparability between financial statements over different periods. Investors and analysts are able to compare the performance of a company over time with greater confidence, which helps in decision making. Question 3. What are retained earnings? Explain its importance. Retained earnings refer to the cumulative amount of net income that a company has retained rather than distributing the same to shareholders as dividends. These earnings are reinvested in the business for various purposes such as expanding operations, purchasing new equipments, or paying off debts. Retained earnings are part of shareholders' equity on the balance sheet, reflecting the portion of profits that have been reinvested in the company rather than being distributed as dividends. Retained earnings are calculated by adding net income to the opening balance of retained earnings and then subtracting any dividends paid to the shareholders. Thus, retained earnings is equal to opening retained earnings plus net income minus dividends. Hope it is clear to all of you till this time. Investors often look at retained earnings to gauge a company's reinvestment strategies and its ability to generate profits over time. A growing retained earnings balance may be the indication of a profitable company with good reinvestment strategies. Now let us look at the question number 4. What is contribution margin? How do you calculate the same? Contribution margin is a key financial metric which represents the amount of revenue that is remaining after deducting variable costs associated with producing and selling a product or service. Thus, it is calculated as contribution margin is equal to sales revenue minus variable costs. Variable costs are those which vary directly with the production or sale of goods or services. Examples include direct materials, direct labor, and variable overhead costs. Thus, contribution margin represents the amount of revenue available to cover the fixed costs and contribute to profit. A higher contribution margin indicates that a greater proportion of sales revenue is available to cover the fixed costs and contribute to the profit. Hope this is clear. Now, let us look at question number 5. What is break-even analysis? How do you calculate the same? Break-even analysis is a financial tool used by businesses to determine the point called the break-even point, at which the total revenue equals total costs, resulting in neither profit nor loss. Break-even analysis thus include various components like revenue, fixed costs, variable costs, and break-even point. Companies calculate the break-even point to identify the amount of sales required to cover all the fixed costs to start generating profits. The break-even point is calculated by using the formula break-even point in units is equal to fixed costs divided by sales price per unit minus variable cost per unit. which is equal to fixed cost divided by contribution margin per unit. As the break-even analysis helps to determine the level of sales needed to cover all the costs and achieve profitability, it helps in decision making for setting up sales targets, pricing strategies, and production levels. It also helps in evaluating financial risks associated with launching of new products or services. Hope you have understood all these questions that we discussed today. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. You may subscribe to my channel for many more interesting videos in the field of finance, accounts, and costing. If you have any question, please leave your query in the comment section. Thanks for watching.